Hi, I'm Trevor Allison, founder of Authentic Life Financial Planning. In this video, we're diving into ISO Taxation 101. All right, well, let's talk about incentive stock options and how they are taxed. So incentive stock options are kind of interesting. So they have three separate ways that they can be taxed, and it all depends on when the shares are ultimately sold. So on the left here, there's three different disposition types. So sale, when is the sale actually happening? There's the qualifying disposition, qualifying disposition, which means that the shares were sold more than 2 years from grant and more than 1 year from exercise. That results in a qualifying disposition. We'll talk through what that means from a tax perspective. And then the other two are both the disqualifying dispositions, but the only difference between these two is when the sale takes place. One is exercising and selling in the same tax year. Doesn't need to be the same day, but if you exercise today and then sell again, before the end of 2025, that's how those shares will get taxed. For the last one, it's also a disqualifying disposition, but it is when the shares are exercised in 1 year and then sold in a different year. That has kind of a hybrid taxation where it has some of the qualifying disposition effects, but it also has and is mostly set up as a disqualifying disposition. So let's talk about the qualifying disposition first. So when you exercise and hold an incentive stock option, and you hold for more than 1 year from exercise and more than 2 years from grant, when you eventually sell, those shares are taxed as a long-term capital gain above the exercise price. So exercise price, and then whatever gain happens, that difference, that bargain element, is taxed as a long-term capital gain. The thing that makes ISOs complicated is that the bargain element between the exercise price and the fair market value when you exercise, that bargain element, is also included in your alternative minimum tax calculation for the year. Which is, again, that's where it gets complicated. That's where things start to get a little confusing, because, when I said there's two different brackets, well, technically there's actually a third, which is the alternative minimum tax bracket. And we'll talk a lot more about that in just a moment here. But that bargain element is included in the AMT calculation for the year. Now, that doesn't mean that you will owe AMT in that year, but you might. And again, we'll talk about that in a little bit here. From a tax perspective, exercising and holding ISOs for, again, 2 years from grant, 1 year from exercise, and then selling at that point is the best option. And that's purely just from a tax perspective. It results in the lowest amount of tax paid. Now, that doesn't mean that that is the best option for you. It doesn't mean that that is what you should do every time. There's a lot of variables to that question, but purely from a tax perspective, a qualifying disposition is the best option when it comes to incentive stock options. Let's talk about this second one. So this second option is a disqualifying disposition when these shares are sold in the same tax year, but they're not exercised, or they're exercised and sold, in the same tax year. So what happens in that case is that the bargain element between the exercise price and the fair market value on the exercise date is included as compensation income in that year. If you sell all the shares at that time, so you exercise and sell, do a like cashless exercise and just take the cash, that's it. That's all the tax consequences that happens. Nothing else matters at that point. If you exercise, in March and then don't sell until December, what ends up happening is the bargain element between the exercise price and the fair market value on the date of sale is still included as compensation income, but any growth that comes after that fact, after the exercise date, is included and is taxed as a short-term capital gain in that year. So you're in that situation, you're paying compensation on the difference between the fair market value and exercise price on the exercise date. And then you also pay short-term capital gains on any growth that's happened since then. In that situation, there's no AMT whatsoever. It basically is a non-qualified stock option at that point. That's essentially how it gets taxed if you exercise and sell all in the same year. The last option is, again, it's still a disqualifying disposition, but you exercise in 1 year, one tax year, and then you sell in a future tax year. But it's within the 2 years from grant and 1 year from exercise, timeline. So an example of that is, let's say you exercise in April 2025, and then you end up selling in February 2026. That would be a disqualifying disposition regardless of when the shares are granted to you. They could have been granted, 10 years ago, and it still would be a disqualifying disposition. In that situation, what happens is the bargain element between the exercise price and the fair market value on the date of sale, that difference is included as compensation income in 2025. And then any growth that has happened since then is taxable as either a short-term or long-term capital gain in 2026. And I actually misspoke. One thing I want to clear up. In 2025, that bargain element is actually included in the AMT calculation for the year. So since even though you end up having a disqualifying disposition, you still end up paying or potentially paying AMT in the year that you exercise because you haven't sold yet. And so once you do end up selling, that difference between the fair market value and the exercise price, that's compensation income. Any growth above that is taxable as either short-term or long-term capital gain. Now, you may be like, wait, how can I have a long-term capital gain on something that I held for less than a year? Well, the way it ends up working is that you don't have to hold it for 1 year or less with this disqualifying disposition type. One thing that potentially could happen is if you're able to early exercise, you could end up early exercising when the shares are granted, and then you end up paying AMT, the difference between the fair market value and the exercise price would be included in AMT for the year. But if you end up selling once some of the shares have vested just a year later, it's been more than a year from exercise, but it's been less than 2 years from grant. And so the difference between the fair market value on the date of exercise and the fair market value when you sell is included as long-term capital gain. Just kind of a weird situation. It's not very common or likely that would play out. Most likely if you were to early exercise or you were in a situation where you're going to have long-term capital gain on the growth after the exercise, you're likely ending up in a qualified disposition where all of it ends up getting taxed as long-term capital gain anyways. Well, that's kind of a long-winded way to say that ISOs are very complicated. They just are, especially from a tax perspective, and that ignores whether or not you should actually exercise or when you should sell. So ISOs are very complicated. If you have them, I highly recommend that you hire someone who is well experienced in them because they get messy very, very quickly. Well, so we've talked a lot about taxes already. That's kind of the point of this webinar today. But now we're going to start talking about an alternative minimum tax. So alternative minimum tax is essentially a kind of shadow tax system that sits alongside the regular tax system. Within the regular tax system, I'm including ordinary income taxes. I'm including the long-term capital gains bracket. And AMT kind of sits next to it as a separate way to do taxes. AMT was originally created to make sure that high income earners were paying at least a little bit of tax. What's happened since it was originally created, and specifically with the 2017 Tax Cuts and Jobs Act, there's very few things that trigger AMT. Really, the only thing that affects, most people who would be watching this, are incentive stock option exercises. That's really it. There are some like real estate transactions that can trigger AMT, some other like very niche things that can trigger it. But for most people, they won't be affected by EMT at all. And really, the only people that do are people who exercise incentive stock options. So I'm not going to talk about the exemption and the brackets at this point. What matters more is just to know that A, it exists, and B, why it gets triggered, which usually is due to ISOs. Specifically exercising and holding an incentive stock option. Thanks for watching. If you found this video helpful, please like, subscribe, and drop a comment below with any questions or topics that you would like to see covered. Financial planning is all about creating the life you want. Let's build it together.